Legendary financial journalist Jason Zweig recently posed a provocative question in the Wall Street Journal. Should you just buy stocks until you die? As someone who strongly believes in owning the great companies of the world for the long haul, I'll admit it's an intriguing question. After all, the stock market might be the most accessible wealth creation tool ever invented, and history supports that claim. Patient, disciplined, diversified investors with long time horizons have done remarkably well. The only thing that the market consistently punishes is unnecessary activity. So you might assume the answer to Zweig's question is an enthusiastic yes. If only it were that simple though. Whether we're talking about investing, charitable giving, retirement, or college planning, there's no such thing as a one-size-fits-all solution. The truth is, good planning requires nuance. Yet the media often ignores that. It loves bold, absolute answers like everyone should own stocks, cash is trash, and bonds are dead. The reality, of course, it's far messier. For a select group of people, an all-equity portfolio can make perfect sense. Maybe they have reliable income from pensions and annuities covering all their needs and wants. Maybe they view their investments as a legacy for their grandchildren, not a source of near-term spending. Others might live comfortably off the dividend income their stock portfolio generates. In those cases, being 100% in equities could be entirely rational. But that doesn't mean that everyone in these situations should do it, or that it's the right move for anyone else. Many retirees want a small cushion of stability for emergencies or peace of mind. Others with more complex income streams may need larger allocations to bonds to help weather periods of volatility. These are all valid and thoughtful choices, not signs of weakness or conservatism. Zweig ultimately concludes that few, if any, investors should hold an all-stock portfolio, not because people lack nuance, but because future stock returns may not be as strong as in the past. He's right that there's no guarantees, but what often goes unsaid is this: no asset class guarantees success. Not equities, not bonds, not real estate, gold, or crypto. Take bonds, for example. Many investors thought they were safe in 2020, yet 5 years later, broad bond indices have posted negative total returns. Cash, meanwhile, has struggled to keep up with inflation. Contrast that with global equities, which quietly and imperfectly have roughly doubled over that same period. That doesn't make stocks risk-free, though. It simply highlights that every investment carries risk, even the ones that feel safe. The media often focuses narrowly on stock market volatility while ignoring the silent risks of inflation, illiquidity, or opportunity cost. As financial planners, we don't get to ignore these trade-offs. Our job is to help clients balance all forms of risk, short-term and long-term, market-related and not, based on what their plan requires. No formula guarantees success, but through thoughtful analysis, diversification, and proactive tax and withdrawal planning, we can tilt the odds in your favor and prepare for life's inevitable surprises. The bottom line is this: at its core, good financial planning isn't about finding the perfect mix. It's about making the right combination of decisions, investments, and otherwise, to live a meaningful, well-rounded life on your own terms. That's the nuance that matters most, and it's exactly what we aim to deliver every day.